All right, let's get started. Let's get this show on the road. So, good evening, guys. We're very excited. We're very excited that you're here. We're very grateful that you're here. So, we're going to begin. So, welcome to the San Jose Apartments investment webinar. We're actually very excited to share this deal about our latest acquisition in Jacksonville. So, before we begin, our lawyers wanted us to read this disclaimer. So, I'm going to quickly read through all this boring stuff so we can get to the really nice stuff. Okay. So the disclaimer is the following content is strictly informational and provided to prospective investors and others. The information is not an offering to sell either a security or a solicitation to sell a security. At the request of a recipient, the company will provide a private placement memorandum, subscription agreement, and the limited liability company operating agreement. The managing member in no way guarantees the projections contained herein, real estate values, income, expenses, and development costs are all affected by a multitude of forces outside the managing member's control. The investment is illiquid, and only those persons that are able and willing to risk their entire investment should participate. Please consult your attorney, CPA, and/or professional financial advisor regarding the suitability of an investment by you. Great. So coming to the agenda, guys. Before going further, I just wanted to provide a structure around the agenda for today's webinar. Please, we're going to open the floor up for question and answers after we're done with the webinar, but please, if you have some questions, please type them into the Q&A box. You can also email us your questions at info@boardwalkwealth.com, or you can also send it to contact@bldcapitalgroup.com. You can also email it to one of the co-GPs who we are grateful has introduced us to you, and we'd be happy to answer it in as much detail as you like. So I will begin by sharing the opening remarks, followed by introducing our superstar team. Then we'll dig deeper into the market, the deal, and the offering. We're going to close out the presentation after that and open up the webinar for a Q&A session. Right, on to the fun stuff now. So guys, being experienced investors, we always like to present the highlights and the risks together because we feel it provides a holistic overview of the entire deal. Because frankly, guys, all deals have pros and cons, and we like you to know both sides of the coin. So that being said, this way you can balance the pros and cons. And that being said, the San Jose Apartments are 138 unit stabilized multifamily property. Now, what does that mean? That means stabilized means that occupancy is over 90%. In this particular case, the occupancy has gone up to 96%. Our business plan calls for a $1 million renovation budget on a proven value-add business model. Now, this is proven value-add business model both in the asset, which Lennon and Stoney will talk about, as well as in the submarket, which Lennon will dig deeper into. We will be teaming up with the best-in-class property management team, ResProp, and Stoney will share more details about why we're very excited to be working with ResProp, because they're one of the best property management companies out there. That being said, just to provide some context around the numbers, Southside, the submarket where San Jose Apartments is located, is one of the fastest growing submarkets in Jacksonville. And Jacksonville is consistently ranked in the top 5 fastest growing MSAs in the country. Excuse me. So the Southside submarket grew at 5.1% year-on-year rent growth. And we've taken this down way less. We're in the 3%, 3.5 or 3.49% range, just to be conservative, and then 2.5, 2.9 onwards from years 2 to 5. To give you an idea, for our underwriting, we're very conservative by nature, right? So for our underwriting, we have assumed a very conservative $65 renovated rent premium. Currently, the renovated units on the submarket are easily achieving between $75 to $125 higher rents. And to provide further context around these things, San Jose Apartments have below market rents between $150 to $300. We feel that this provides our investors even more cushion, as safety of principal is one of our key metrics whenever we're looking at any deal and doing any deal. That being said, I'd like to mention about the risks as well to give you a complete picture. So the risks are very similar to what you see in similar multifamily deals. So the two big risks include the business plan execution and changing macroeconomic conditions. On to talking about the superstar team. So as some of you know, I'm the guy on the left. The other two, the prettier pictures, my partners will talk about soon. So as some of you know, my name is Umar Khan, and I'm the founder of Boardwalk Wealth. I have done over $3.7 billion of M&A and capital financing transactions. My primary roles include deal sourcing, underwriting, contract negotiations, and asset management. I'm a CFA charter holder and have over a decade of experience investing on the institutional side.
Thank you, Omar. Hey guys, this is Lennon Lee here. I'm one-third of the asset management team for San Jose Apartments. I'm a full-time real estate investor based in Miami, Florida. My experience in real estate began with the acquisition and then the ongoing management of my family's portfolio in South Florida. That was in 2009 when we acquired that. I'm the founder and principal at Build Capital Group, which is a real estate investment firm focused exclusively on Class C and B multifamily acquisitions. Alongside my operating partners and investors, we have acquired 1,500 plus units across 6 projects for a total dollar amount of around $150 million now. I'm also the founder of the Multifamily Investing Club, a networking and knowledge sharing community that provides education and a team building platform for local multifamily investors in the South Florida and Miami area.
Thank you, Lynn. This is Stoney Stonebreaker. I'm managing partner of Earthrise Investments. I'm a real estate investor from Coral Gables, Florida, and I've invested as a limited partner in over 600 multifamily units in Texas over the last 2 years. My prior investing has been in other income properties in Florida and North Carolina. Most of my career has been spent in telecommunications technology, including starting a radio tower leasing company, a long-distance resale company, and a fiber optics transmission company. Prior to that, I worked in the space program with NASA. My educational background is electrical engineering and an MBA and postgraduate studies. Now, let's talk about one of the most important decisions we could make, which is partnering with a strong property management company. As Omar mentioned, we're partnering with ResProp, the new name for Avesta, a name which experienced real estate investors may be more familiar with. They are already the owners and operators of the San Jose Apartments. On our initial trips to Jacksonville, we interviewed all the major property management companies in Jacksonville with a thorough prepared list of questions. One of the questions we asked them all was, if we don't select your company as our property management company or partner, which other company or companies would you recommend we consider? In every case, the other property management companies listed ResProp as one of their highest choices. They're either first or second choice. On subsequent trips to Jacksonville, we also asked brokers, contractors, and others which property management company they would recommend. And again, every single one included ResProp. With 14,000 units under management, including 1,700 in Jacksonville alone, we feel very good about the strength of our property management partner. Next, let's take a look at the Jacksonville market. First, we'd like to show you a 3-minute video produced by the Jacksonville Chamber of Commerce, which is an excellent introduction to the area. Let's take a look. Great, okay. With that introduction, when we first selected Jacksonville as our first Florida target, it was because of the strong multifamily metrics. One metric I like is the affordability ratio, or the cost of rent compared to income. In Jacksonville, the average rent is 19.5% of income. That compares very favorably to the U.S. average of 28%, leaving plenty of room for growth of rents. Other Florida markets are not nearly as renter-friendly, especially in South Florida, where rents can be greater than 50% of income. As one might expect in a high-growth state such as Florida, job growth and population growth in Jacksonville is about 2 times that of the U.S. average. In fact, about 1,000 people move into Florida every day of the year, a trend that has been relatively consistent for decades. In most years in Jacksonville, demand has outstripped supply in multifamily apartments. Next, we have a pie chart that shows the diverse economic base of the Jacksonville area. Key industries include healthcare, finance, banking, and insurance, logistics, tourism, and the military. This diversity helps Jacksonville resist economic downturns. Part of that diversity are 3 Fortune 500 companies that are headquartered in Jacksonville. Those 3 companies are FIS, which is the largest financial technology company in the world, with 52,000 employees worldwide, handling over $9 trillion in transactions annually. Second is Fidelity National Financial, the largest title company in the United States, and also handles many other real estate transaction services. CSX is a 190-year-old railroad, transportation, and logistics company. Many people may not know that Jacksonville is rarely threatened by a hurricane. The warm waters of the Gulf Stream off the shores of the Atlantic may have some impact on steering hurricanes away from the area. Now let's take a look at the submarket. The South Side submarket, where the San Jose apartments are located, is a top 3 submarket for B and C multifamily properties in Jacksonville. It is surrounded by a prosperous residential neighborhood, including the San Jose Country Club, the Eppings Forest Yacht Club, and the Bowles School, a private college prep boarding school, one of the best schools in Florida. The average household income within a 5-minute drive is over $72,000, and average home values are over $300,000. The property is within a 15-minute drive of 40 million square feet of office space and 2 million square feet of retail stores. Major hospitals and healthcare clinics are within 20 minutes, including the Mayo Clinic, the #1 hospital in Florida. One of our first concerns with any property we evaluate is whether it is in a flood zone. It is one of our first key metrics when looking at Florida properties. As you can see with this map, San Jose is not in a flood zone. Now we move to some photos of the area to give you a general sense of the area. On the left, we are looking to the west from the San Jose apartments. And along the St. Johns River on the left is a site of Eppings Forest, an historic 58-acre estate with a luxurious riverfront mansion built in the 1920s by industrialist Alfred I. DuPont. It has been restored to its original grandeur, is home to the Eppings Forest Yacht Club, which is on the National Register of Historic Places. The photo on the right looks to the south and the San Jose Country Club, which was built in 1925. The golf course was designed by the renowned Donald Ross, and the club is also on the National Register of Historic Places. Next photo on the left looks north towards downtown Jacksonville, which is highlighted in magenta. I wanted to give you a sense of how far away it is, so I consulted my favorite GPS app, Waze, which reports the morning rush hour drive to downtown is 11 minutes. Not bad. I wish I'd had 11-minute rush hour drives most of my life. And on the right, finally, looking eastward, I-95 is less than 1 mile from the property, giving quick access to all parts of Jacksonville and points south in Florida and north into Georgia and the southeast.
All right. Thank you, Stoney. This is Lennon, guys. Stoney, thank you again for walking us through the highlights of the market. And listen, guys, by the way, before I continue, I just want to say that we very much value your time, and we appreciate you taking part of that time to join us today. The idea of the webinar is to provide an overview of, like Omar said before, the market, the deal, and the team behind it. So today we want to walk you through some of the stuff that's not already included in the investment summary, but without going into much detail that we would take much of your time. Instead, again, like Omar said before, we encourage you to ask all the questions you have via emails or through the Q&A box, so we can spend more time talking about the things you really want to know about. That will come at the end. That being said, I want to get now into the story of how we got the deal. As a team, Stoney, Omar, and we were firm believers in the power of building relationships, and relationships exactly was the main driver behind us getting the deal awarded to us. So a few months ago, we started traveling regularly to Jacksonville with the idea of starting to meet with some of the more active brokers in the market, as well as getting to understand the dynamics of the Jacksonville market in person. Because I think that it doesn't really matter how much you talk to brokers on the phone and read market reports and use Google Maps to check out the area and all that. Nothing will really beat the in-person conversations and a good old drive by the streets of the target market. So through multiple market visits and broker meetings, we built a strong relationship with the listing broker for San Jose apartments that as soon as the property was on the market, we were able to go and schedule multiple property tours, not only on our own with the broker, but also we brought our contractors and we toured the property with them so they could start giving us some feedback regarding the CapEx budget, the ideas for some of the amenities that we wanted to implement, and just overall things that we needed to take care of. By the time offers were due, our relationship with the broker was very strong at that time. We had proven to him and to the seller that we were serious and very diligent, and they very much appreciated that. Also, because of the intentional relationship building approach that we were having in this market, we were able to have some of our local contacts verify some of the information that we were getting from the property management company and from the broker himself. You know, the type of thing like trust but verify, right? The boots on the ground contacts that we had were very helpful to us, especially at the beginning when we first started looking into the deal. They actually drove the property several times on the week, several times of the day even. They took pictures, videos, and of the property, videos of the area as well. They sent it to us, and we were able to compile that information and compare it to what we were looking at in the OM and in the market reports. So this was very, very helpful for us. And just to finalize the whole story of how we got the deal, the last big thing that allowed us to separate ourselves from other groups was the creative vision that we had for the property. While other potential buyers were looking to add value to the property, they were not really looking to reposition it from its current Class C into a B class asset. Us, instead, because of the multiple visits to the area and the comps, we were able to identify an opportunity to come up with a bigger renovation budget that would allow us to bring San Jose apartments to a level above the immediate comparables in terms of the product, but to a level below some better located non-direct competitions in terms of the rent premiums. Basically, positioning ourselves in between both. So next, I wanna answer a question and talk about something that, you know, it's very typical and a very valid question, and that's why is the seller selling? That's something that we all have, you know, a question that we all have when looking into a deal. So we definitely wanted to include that in the presentation. So the short answer, guys, is that the current owners, they met their investment goals and they're ready to cash out and move their capital into new ventures. That's basically it. The long version is that the owners of San Jose Apartments, they purchased the property in 2012 as part of their acquisitions within their first fund. Those of you that are familiar with the dynamics of a normal real estate fund, you know that they are structured in a way that they basically are obligated to sell after a certain period of time for the investors or after they hit certain targets. This is exactly the case with San Jose Apartments and the current owners. They bought it at a very attractive time and were able to hit their investment goals fairly quickly. They continued to reap the rewards for a few years, took good care of the asset in general, and now they're liquidating that fund. So they're disposing of all of those assets and actually starting to raise capital for a new fund. So there you have it. That's the reasoning behind the disposition of this asset from the current owners. So why San Jose Apartments, you might ask? Like, why do you guys love this deal? So the answer for us comes in like basically in 4 parts. The first thing is that we love the property's location. It's a beautiful location. And as Tony mentioned before, San Jose Apartments is located in the south side Submarket, where only 3 apartment communities have been delivered in the past 20 years. And only 1 delivery is planned for the foreseeable future. And that to us, that's very, very good sign. Actually, because of the shortage of supply in the area, the market concessions have been at 0% for the past 12 months. So again, that tells you something. And just overall, the Submarket is performing better than the already high-performing Jacksonville market as a whole. And that's something that we look for when studying areas for investments within a MSA itself. And then we have a few other reasons why we love the deal, and they're all related to something I mentioned before, and that's that the current owners have more than exceeded their investment goals on this deal. And they have basically stopped pushing the performance of the property to its maximum potential. So we found ourselves with a property with a lot of meat on the bone still, where rents are well below market, and that combined with a neglected curb appeal desperately calls for a strategic value add program on the interior as well as on the exterior, and that's something we seek for in our deals. And just to round up the deal completely, we really like that the current owners, while not really pushing the property to the limit, they have been taking good care of the property in terms of infrastructure. They spent a good $1 million in the property after their acquisition to take care of all of the deferred maintenance, mainly the big ticket items. Basically, leaving high ROI plays or high ROI investments for the next owners, which is going to be us, to take advantage of. So we are very excited about that. Now, moving into the meat of the presentation, and something that I'm very excited to talk to you guys about, and obviously we're very much looking forward to start executing as soon as we close. For this deal, we had to, I mentioned this before, we had to think outside the box to differentiate ourselves from other buyers. So 2 of us in the asset management team, Stoney and I, are Florida natives, and that allowed us to visit the property and the area several more times than the other groups. In fact, Stoney and I, we're currently calling in from Jacksonville. We're here for 3 days now, and we've spent the past 2 days doing the walkthrough of the units with our property management team and the contractors. And also, by the way, tomorrow we will be doing an investor tour of the property. So if you're in the area by any chance and want to join us for the tour, feel free to shoot us an email so we can add you to the list. We'll meet you there tomorrow. But anyway, being locals to the Florida market really translated into us having the ability to come up with a plan that it's only possible to come up with, or was only possible to come up with, if you really spend the time understanding the comparables in person, the dynamics of the market, and the property itself. So overall, the plan is to reposition the asset from a Class C to a Class B that is going to be more in line with the location. We decided to use Lakewood Village, one of the comps, which is an older but slightly better located property as our anchor comparable. The owners of that asset have proven their value add play. They recently spent a lot of money implementing a value add program there, and that is getting them an average of $300 rent premiums versus the current rents at San Jose. While we don't expect to compete directly with Lakewood Village, we do believe it's our ideal comparable. It's only 1 mile west of San Jose Apartments, and a lot of the tenant base there that lives there, they drive through San Jose Apartments every single day. So we will be able to position our product slightly below them in terms of the quality of the unit and the location and the property overall, but very well below them in terms of the asking rents. So as Omar mentioned before, we are going very conservative and we're only underwriting $65 renovated rent premium when other direct competitors in the submarket are achieving up to $125. In fact, at this point in time, we have information from our property managers that some of the studio units are already achieving our underwritten renovated rent premiums without even being renovated yet. So that's something that we're very much looking forward, and that has us very excited. In order to successfully reposition the property, we will be focusing on 3 major areas, which is the brand, the interior of the unit, and the exterior look and the feel overall of the property. For the interior renovations, we have allocated $700,000 to be spent on 75% of the units over a 20-month period. The idea of leaving 25% of the units without renovation is to leave some meat on the bone for the next buyer. This will allow us to offer a good value-add story that at the end will be favorable for us at the time of disposition of the asset. Of course, this is not set in stone or anything. It's going to be depending on market conditions. So we can maybe decide to do improvements on more than 75% of the units. But in any case, like I said before, we're underwriting $65 rent premium above the trailing 3 rents. So it's basically proven already. And moving on to the exterior renovations now, the plan is primarily based on a curb appeal enhancement play. The thought process here is that no matter how good the interior looks, the majority of potential tenants, they make their decision or almost make their decision before they walk into the unit. So whenever they drive into the property, they're already starting to feel whether or not, or to decide whether or not they want to live in this property. So only after they get into the units, they confirm their decision. But again, the exterior is very, very important for us, and we will spend a lot of money out there to make it beautiful. We're going to be taking advantage of some old oak trees that we have around the property. We're going to do some extensive trimming, tree trimming work to lighten them up and kind of bring them back to life. We have plans to add some modern amenities like a new pool furniture, new outdoor kitchen with a pergola, also in the pool area. We're going to be installing a dog park. Many properties in the submarket have around 40–50% of their tenant base with pets. And at San Jose, we only have around 20% of the tenants with pets. Our goal is to increase that percentage in order to start bringing more revenue to our bottom line via pet fees and pet rents. The other common area improvement is going to be installing a modern monument sign that is going to be more representative of the new brand that we're going to bring. This, of course, it's tied into the whole repositioning play, because only by implementing a rebranding strategy will we be able to bring a new tenant base into our community. With a new monument sign, a modern exterior paint job, and an overall shift in the marketing approach, we will be able to position the asset as a place where people will be proud to live in. That's our goal. And guys, all of this implementation will be done hand in hand with our property management team from ResProp. As Tony mentioned before, this company owns and operates around 14,000 units across 4 states. More specifically, they own and manage 1,700 units in Jacksonville, including San Jose Apartments. So yes, they are actually managing the property right now, and we couldn't find better partners than them. The idea is not only to have a seamless transition between ownerships, but that these guys actually know the property better than anyone out there. And just to wrap up the business plan up, I would like to touch on our exit strategy. The main plan is to hold the asset for 5 years and then sell it. That being said, we believe that after 3 years or so, depending on the market conditions, we can start looking at a disposition option. Also, we will start exploring avenues for a refinance play after we complete the business plan after 2 years. That's not something that we have underwritten for or included in the projections or anything, but we certainly are going to be pursuing that option as well. So there it is, guys. That's the business plan. Omar, take it from here, man.
Thank you, Lennon. Thank you, Stoney. So guys, just to give you an idea, I'm going to show you some of the interior renovation plans we have. On the left, you see a standard unit. It's also called a classic unit at times. Now, this is your typical unit, where you're doing a lot of value add. It's got white everything. The floor plan is really closed up. And what we're going to do is, as we're repositioning the property, you can see on the right with the sample renovated unit, we open up the floor plan. We add two-tone paint. We get black or faux stainless steel appliances. And then we basically make it look just a lot better, strikingly better. And because we've increased the curb appeal, we've improved the quality of the renovated units, and because we have better marketing power behind us and a more strategic plan, we're just able to hit the ground running. And that just kind of gives you an idea. We wanted to show you both units side by side to give you a better idea of how the finished product looks, just to give you a better idea. Now, moving on to the upside potential, guys. Just, all three of us have a quantitative background. I'm in finance, Tony and Lennon are engineers. So every time, we're looking at a deal, we're buying a deal, we're investing in a deal, we're always looking at optionality. Like, how much flexibility does this property really have? Because, as none of us has a crystal ball. So we kind of have to always go into a deal, always being conservative. And you've seen that with our underwriting and our assumptions, but also having upside optionality. So in this case over here, one of the best things that we had going for us is the fact that this property basically has the ability for us to construct 32 units. So we've checked this with building and zoning, and this property is zoned for an additional 32 units. Now, what does that do? This provides us with upside optionality, as we have the ability to grow rental revenue in one of the fastest growing submarkets of Jacksonville. But if we don't decide to avail this opportunity, we can then present this opportunity at disposition to the next buyer, and that helps us get a better price. So when we're selling it, we get a better price. Now, number two, and again, both of these things are not included in the underwriting because we want to stay conservative. Number two, washer and dryer hookups. Now, we can implement washer and dryer hookups on select units, and we're actually going to be showing that as part of the tour tomorrow. Now, as we all know these days, washer and dryer hookups are one of the most in-demand amenities by tenants. And from our research, depending on the unit type, we can easily add between $35 to $80 rent premium on top of the rent. So right on top, you see, have a bedrock of conservatism, have a lot of upside optionality. And what that really does is, with these things not being included in the underwriting, it gives us a lot more juice and a lot more room to play with, right? So coming to financing, this is actually one of the most important slides, and I always look at this. So because of our relationships with both the brokers and the lenders, we've been able to secure very attractive financing here. It's a non-recourse loan from Walker & Dunlop at very attractive terms. Now, as some of you know, Walker & Dunlop is one of the largest multifamily lenders in the country. And the interest rate is very attractive at LIBOR plus 310. And check this out. We have 3 years of interest-only payments. Now, why did we choose this particular financing product? The reason why we chose this particular financing product is because it gives us the operational flexibility to implement our value add plan. And then at that moment in time, we can decide either to sell the property or refi into a permanent agency debt. Now, if you just go with an agency debt, which is great, by the way, don't get me wrong, the problem there is that if you're trying to refi, if you're trying to return a lot of money back to your investors, a lot of times you have the ability of incurring a lot of prepayment penalties. So with us, because we're repositioning, we've got a great loan, a great asset. This was just a perfect fit. Now, coming on to risk management. Guys, we actually feel that this really sets us apart from a lot of other folks. Like we mentioned, safety of principle is one of our key metrics, and we build everything on a bedrock of conservatism. So here, you can see at the start, we have the interest rate cap. Now, what is the interest rate cap? When we purchase an interest rate cap, it helps us mitigate our exposure against rising interest rates. Now, what happens is, if the rates rise above a certain rate that we bought the interest rate cap, we actually get paid. So we bought a contract that says if rates rise above a certain amount, we actually get paid. What does this do? On top of having really attractive debt, it locks us in and helps mitigate exposure against rising interest rates. Then, with the seamless property management transition, now why did we do that? We've talked about retaining ResProp, one of the best in-class property management teams out there. But for two big reasons why we feel the seamless property management transition is going to be even better for our investors. And those two reasons are efficiencies on the construction management and efficiencies on cost. So efficiencies on construction management, are basically because of the size and scale at which ResProp is operating, we're able to secure pretty much all of the construction material for a value-add project at very attractive terms. By the way, at the prices at which we're able to procure these items, a lot of the competition isn't able to procure them at this price. Then on the cost efficiencies point of view, again, because of the size and scale of ResProp and our strategic partnership with them, we're able to get lower costs pretty much across the profit and loss statement. And to give you an idea, in Jacksonville right now, for a property of this size and this vintage in this submarket, insurance costs are roughly in the low 400s. And we are able to get on the ResProp's property insurance, and we're able to get it around the $350 mark. So right off the top, we're saving over $50 just by partnering up with ResProp. And by the way, this is just one example of many examples right across the profit and loss statement. And then on top of that, we feel that our experienced management team is going to ensure speed and efficiency in ensuring the smooth execution of the business plan. And guys, a big reason for that is our experience. But the other reason is also we're always looking for asymmetric bets, basically where the odds are tilted in our favor. And in this particular market, as Tony talked earlier, there's a demand and supply imbalance. There's a lot of demand and hardly any supply. That's why you have 0% rent concessions. And those are the kinds of assets and those are the kinds of properties we are always looking to buy. So that just kind of rounds out the risk management pyramid. And we wanted to show this to kind of show you how do we view things apart from conservatism, apart from conservative underwriting, apart from doing our all the property checks and due diligence. How are we just looking at properties when we buy them? Now coming on to the offering. The San Jose apartments are structured as a 506B offering. Now what does this mean? This means that the investment is open for accredited and select sophisticated investor. So please keep in mind that although we have sophisticated investor slots, we only have a limited amount of sophisticated investor slots. So the minimum investment is $50,000. The asset management acquisition fee is 2%. And we have a very friendly investment structure where it's an 8% preferred return and a 70-30 split with no disposition fees. So these are the types of structure, guys. When we're investing in deals, these are the structures we're looking at. And when we look at these structures, we want our investors to also get the same type of structure. Now, just some closing remarks, and we're going to open up the floor to Q&A. Just big picture-wise, guys, the PPM is scheduled for release the first week of January 7th. And the funding for the dates for when the funds must be transferred to the bank accounts is January 15th, with a projected property closing date of February 20th. So what are the next steps, guys? You can email us. You can set up a call. You can reserve your spot at the link over there. Don't worry, we'll send it to you. We'll also send you a recording of this webinar. Or you can also get in touch with one of the co-GPs who we are privileged enough and grateful that they've introduced you to us. Well, that being said, I just want to open the floor up to some questions, and I'm going to begin, first of all, by answering Layla's question. She was kind enough to put it on the Q&A box. How far below markets are the rent currently? So that's a really good question, Layla. That's actually one of the first questions that we always look at. So for renovated units, as Lennon mentioned, they're up to $125 below market. But overall, if you look at the complete picture, it's between $150 to $300. That's how much below market the rents are. That being said, we also have one or two more questions. Lennon, do you want to start?
Yep. So yeah, I got a question here, and something I think that very important question actually, and it's about the reversion cap rate. How will we? Because a lot of people say they're being conservative, but in our case, we do believe that we're being ultra conservative, at least on the optimism or lack thereof, actually, that we have for the future on this submarket. We are actually underwriting 115 basis points exit cap rate, which is substantially above what conservative underwriters out there underwrite for, actually. So we're very proud of being that conservative and that making the numbers still work for our investors. So yeah, there you have it, 115 basis points. That's the exit cap.
Great.
Another question. Yeah.
So let me answer another question, just following up from Leila. Why are current rents so far below market if supply demand is not in balance? Again, that's a great question, Leila. You're hitting it out of the park today. Leila, the big reason why this is done is, as Lennon mentioned, the fund is actually in the process of disposing off their assets. So number one, this is one of the smaller assets they have. I mean, they have properties that go all the way up to 800 plus units. So because this is one of their smaller properties, they've kind of bought at a really good time, and they kind of didn't really put a lot of money in, and they just kind of rode that wave up. So that's why they've been able to basically make their money and not really push rents. And this is why actually, if you look at comps like Courtyard at San Jose, that has an exponentially higher rent than what we're currently getting. And you can check all of these things through Google, apartments.com. And you can look at Lakewood Village, which is done. So in the submarket, rents are substantially high. Now, why hasn't the current owner do it? Because they just don't have to. They've kind of made their money, and they have a lot bigger fish with which they're dealing with. So I can take one more question. I mean, take a lot more questions. Rome Wells has a question. Can I personally go and check out the property? Yes, Rome, you can go whenever you like. Tomorrow, we're actually doing a property tour. And if you email us, either me at info@boardwalkwealth.com or Lennon at contact@blecapitalgroup.com, we can set up a tour for you. We're already touring with a bunch of other investors. Now, Lennon, do you want to take a question?
Yeah, I'm sitting here. Clay, why is a bridge loan necessary? Well, I think the word necessary is not like it is necessary, but it's the best approach for this property that we came up with. It's going to allow us, like Omar explained, maximum flexibility versus a longer term rate, a longer term agency debt.
Great, thank you. So we have a question from an anonymous attendee. Ooh, anonymous. So what is the role of the co-GPs in this deal? So guys, there are a multitude of roles for co-GPs in this deal: investor relations, due diligence, capital management, signing off on the loan. I mean, you name it. There's a role. This is a team sport, guys. We always work with teams. So that's what the role of the co-GPs is. Danica has a question. Are most of the rentals currently Section 8 tenants? No, Danica. This is also one of the things we check. Most of the rentals, in fact, there's hardly any rental that's Section 8. We made it a point to check this thing. So thank you for your question. Actually, that was one of the things we did. Care for You is asking, how much are you charging for asset management fee, and what is the percentage of a bracket asset potential rent or NOI? So Care for You, the asset management fee is 2%, and it is a percentage of collected revenue. So that's gross potential revenue, net of all economic vacancy, and with the addition of other income. Hopefully that answers your question. Lennon, do you have a question?
No, I don't have any more.
You're not the popular guy? Nobody's emailing you with questions?
No one's emailing. Yeah, I guess you have them all, man.
Cool. So because I think I'm the only one who sees the Q&A box. So Omar Chaudhry, hey, great name, Omar. My name's Omar too. Great choice on the name. Omar Chaudhry says, you mentioned flood. What about hurricanes, tornadoes, or other natural disasters in the areas? What kind of insurance do you have? So guys, Florida hasn't been hit with a hurricane. I'm sorry, Florida has been hit with tons of hurricanes. Jacksonville has only had hit with one hurricane for the past 80 years. Tony went into that. That's primarily because of the warm waters of the Gulf Coast. Apart from that, we have a very comprehensive insurance through ResProp that we've talked about. If you have any specific questions or if you're looking for specific things, I'd be happy to share that with you. So Nadir says, what is the overall interest rate of the loan? LIBOR plus 3.1. Yes, Nadir. The rent interest rate of the loan is LIBOR plus 3.1. Mike C, why the short-term disposition? Well, Mike, we're underwriting to a 5-year hold. The reason why we mentioned the possibility of a disposition is that we wanted to show you the flexibility we have because of the repositioning, but we're not actually planning on selling the asset. We just said, look, if somebody comes, say in year 2, and gives me the price that I projected that I was going to get in year 5, yes, we will sell it in year 2 because we're going to save 3 years and get the price we wanted in year 5. So we're not counting on it. But hey, Mike, if you've got money, man, give us a call. Chris DeSalle. Hey, Chris, what's going on? Time of the tour. So time of the tour tomorrow is, what time is it, Lennon, tomorrow?
It's 12 noon.
It's at 12. We might be able to do a 1 o'clock tour. So.
But
Sure.
for all the people showing up for the tours, bring umbrellas. It's supposed to be rainy tomorrow, unfortunately, here. The front is coming through.
Cool. So Care for You has a question. In your analysis, there is working capital that is being returned to investors as income. Can you explain that? Care, this is very conventional. Because we're repositioning the asset, what happens is we over-raise capital on every deal. Now, why do we do that? We do that to remain conservative because, you know, you don't want to go into a deal backed into a corner. So that's why we raise more capital than we should have. In fact, significantly more capital than we should have, so that we have liquidity on hand and to make sure we're conservative. Now, what does that do? Guys, that does take our returns down slightly. But we'd much rather have slightly less returns, but have ample liquidity and no problems than, you know, kind of cut things really short and then have no liquidity and potentially run a problem. So that's why. Care for You, man, you're on a roll today. So why the selling cost is too low, only 1%? The reason for that is, guys, very simple. The listing broker who's bought us this deal is also going to be the broker who's selling the deal, because they get paid on a round trip, hence we're able to negotiate a better price for them. Rome Wells, what about collateral if money is lost? Rome, can you rephrase that? Maybe I didn't understand it properly. I'd be happy to answer that question. So anonymous attendee, the acquisition fee seems a bit hefty. How did you arrive at $242,000? So anonymous attendee, great question. This is a conventional fee charged pretty much across the board by all syndicators, very typical fee. It's 2% of the purchase price. Now, what a lot of syndicators do is they will say 2% of the total capitalization, which basically means purchase price plus the renovation. But we decided to be more conservative and have a lesser fee. Javier Tejera. Hey, Javier, we talked a few weeks ago. How will an increase in interest rates from the Fed affect the refi and or the sale at the end of the IO period, interest-only period? Or you can answer this in person tomorrow if you think it's no good. Oh, no, Javier, don't worry about it. All questions are good, man. So how will this affect interest rates? Without having a crystal ball and now peering into my crystal ball, Javier, what I can tell you is rising interest rates on average tend to have somewhat of a downward pressure on prices, real estate prices. That's just because as the cost of lending increases, it becomes more and more expensive to actually own the property, or rather to buy a property and finance it. In our particular case, we have mitigated this in two ways. One, we have bought the interest rate cap, right? So that totally mitigates our rising interest rate exposure. Then on top of that, what we've done is that we have a very conservative 115, what is it, basis points increase. How much is it, Lennon? 115?
115, yeah.
Yeah, so we have assumed 115 basis points increase. Now, usually people are doing between 50 and 75. So we're pretty much double, more than double actually, 50 basis points, which is what the average syndicator is doing. Omar Chaudhry, actually great question. Also, Omar, you're on a roll today, man. By the way, great name again. Also, have we checked for potential construction in the area, like huge complex construction? Yes, Omar, we have actually checked for that. And as Tony mentioned, there is only one construction happening that is 3 to 5 miles away, and that's a Class A construction, so that's not competition, and there's only been 3 communities built in the past 20 years. Anonymous attendee, what is the strategy behind offering a preferred return? Great question, Anonymous. So guys, the strategy behind offering a preferred return is very simple. It is a more investor-friendly structure. Now, I've written a lot about this on my blog. Shameless plug, you can go check it out at boardwalkwealth.com. Guys, this is our firm belief, especially having worked on the institutional side. Never, ever, 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 ever take a deal that is just a straight profit split, guys, no matter what the sponsor tells you. Having a preferred return means that till you don't make, as an investor, a base minimum level of money, we as sponsors do not get a dollar. Now, what does that do? That makes sure that sponsors are always operating efficiently. Because if we start sharing money from day one without us having even given you a good enough return, I just don't think that's fair. And that's not how it happens on the institutional level. And that's how we structure our deals. We make sure our investors get a preferred return first, and then we can come in and, split the proceeds on top. Another question by anonymous attendee. Either you're the same person and you've got great questions, or we've got multiple people as anonymous attendees. So when you renovate the inside of the units, how long does it take for the renovations for each unit on average? Do the tenants move out during renovations? Great question. So there's two ways, first of all, we can do it. Number one, I'm gonna answer the second one and then link it back to the first question. There's two ways you can renovate it. Number one, you can go in when a tenant leaves or is evicted, and you can go and make wholesale changes to the apartment, and that's your renovation. Or what you can also do is go making minor changes. So as an example, we go put in a new countertop, or we go put in a new fridge and appliance set. And in this way, the tenant doesn't have to move out. They enjoy, say, a better unit. And that basically, reduces their turnover costs. Now, when do we renovate the units? So guys, roughly in this market with the res prop, we're talking turnover time is about 2 weeks, give or take. And then putting it back on the market is another 2 weeks. So basically on average, it takes 1 month for us to basically go into an apartment, completely renovate it, put it back on the market, and have it rented out. So if you're underwriting to a 5-year hold, but not planning to sell by then, why not go with the 10-year term? So we are underwriting to a 5-year hold, and I don't know if I was clear. I apologize for that. We are planning on selling by year 5. So I guess that hopefully that kind of answers your question. Here, Rome Wells, can you write a couple of apartments on my name in case if I don't get my money? I'm sorry. Rome Wells says, can you write a couple of apartments on my name in case if I don't get my money back? That's what I mean by collateral. Oh, no, Rome, these are securities. So aren't like, just give somebody like half a window or half of an apartment. They're securities. And just to give you an idea, us as sponsors, our money goes in first before anybody's money's gone in. We've already invested over $150,000 into this. And our money leaves in the end. So after everybody's paid, after the lender's paid, you are paid, all the co-GPs are paid, then we get paid. So maybe that gives you an idea. Rome has another question. How often are investments distributed? At the end of each year or at the end of 5 years? No, Rome, we distribute investments quarterly, and that's how we do it. So Anonymous says, was that sample renovation unit what the new units will actually look like? Doesn't seem very trendy. Can't you get a more up-to-date look with the same amount of renovation costs? That's a good question. That's a sample renovation unit, number one. Of course, we make changes as we go along. So we continuously run small experiments. We've seen this on our other assets. Like for instance, in one asset, we will put faux stainless steel appliances, but in the other one, we'll put black appliances, with the idea being that we're seeing, if I'm putting in, say, faux stainless steel appliance, am I getting that extra 15, 20, 30 bucks in rent? Or if I'm putting in vinyl floor plank instead of tile, am I getting the extra return? So that's what the idea is. We can look, first of all, design elements keep changing. We can get a more up-to-date look if we like, but we also have to match the look with what the tenants want. So if the tenants want one thing, it doesn't, we have to go with what the customer likes. That's why we set it up like that. I can possibly, I have some questions that were emailed to me. So what is our viewpoint? What are your thoughts on the unit mix? So guys, this was a question sent by a few people actually. I really like this question again. That was one of the things we were thinking about. So we feel that the property has an interesting mix of unit types. So we feel as this property is one of the fastest growing submarkets of Jacksonville, the studios and 1-bedrooms, we personally feel help us attract a higher paying tenant to maximize net operating income or NOI. And the 2, 3, and 4-bedroom units, we feel, provide the necessary family type, stable type renters that provide us with an NOI stability. So we balance maximizing NOI with stability. And that helps us in being conservative all the way through the time that we hold this property and implement our value add program. Anand, do you have any more questions?
I just have a final one, but it's about the returns. And sorry guys, we didn't bring that up because like I said before, a lot of the information that we wanted to bring up on this call was regarding information that was not on the investment summary. But anyway, the returns, the projected returns, we're looking at a 16.9% IRR, 8.6% cash on cash on average in 5 years, and that equity multiple of 2x. Those are the projected returns. We can definitely share more information via email and answer more questions via email tonight and tomorrow and all the other days. You can set up a call with us. The information is right there on this last slide. Or you can email us the questions. I think it's time to wrap it up.
I can take one more question. I think Zach asked a question, very interesting one, and then we'll wrap it up. So Zach says,
Go ahead.
what's the new construction of 32 units in the pro forma or not? Will you build? So Zach, no, we have not included into the pro forma. Like I mentioned, we wanted to be conservative. We wanted to, not put our, just go guns blazing into the thing. So we've not included this in the pro forma. And we're going to wait and see. And potentially, if we don't do it, then we can use this as an optionality, as a marketing tool for us to get a better price at disposition. So I hope that answers the question. Guys, if you have any more questions, please feel free to email us. You've got our emails here. You have also know your co-GPs. We'd be more than happy to answer any questions. And once again, guys, tomorrow we have a property tour. You're more than welcome to join. And please, let's stay in touch. And we hope that you can join us on this investment. Thank you very much.
All right. Take care. Bye.